So let's begin the show by dissecting the earnings season that we've seen so far. Jigar Mistry of Buoyant Capital is now with us on the show. Jigar, what would be your key takeaways from what we've seen so far? What stood out for you? The ratio of upgrades to downgrades, the EPS changes that you've had to make?
Yes, good morning, Rima. Thank you for inviting me to your show. I think you summarized it pretty well at the start of the show, right? But if we want to delve a little deeper, then let's break it down into the top 4 or 5 sectors. Banking, clearly, we have seen system-wide expansion of NIMs. Something that was theoretically argued even by us that rising interest rates should result in expanding NIMs because assets get priced much faster than liabilities. And that has happened. Now, historically, what also happens is that rising interest rate brings sort of questionable asset quality under some bit of pressure. But given that a large part of incremental demand for the last 5 or 6 years was driven by retail lending, we doubt if that would play out this time around. And yes, the numbers have been good. A few of them you mentioned. The only difference we are making here is that while we are staying with the privates, if you want to increase the risk, we believe microfinance could be the end of, at the end of their bad quarters when they report. So, something like Bandhan or Satin or something, some of those names could have a reasonably okay quarter, but I think that would be the bottom. And that's the way we are preferring to increase the risk in the lending financial space. Technology, you were right. It's not been as bad, but come to think of it, each and every company has not, despite depreciating rupee, has not guided to margin expansions, and if at all, they've come towards the lower end of their guide. Right, and this could arguably be the last of the double-digit quarters, and incrementally we will look at single-digit with valuations not really below average mean levels, right? So you buy these companies because they can arguably go faster, but they are not, and then you are not getting it at a reasonably good valuation. So those numbers have not yet been great so far. I think the one to watch out for will be FMCG because at least we are seeing, the urban fare much better than the rural. And a lot of these urban facing companies, at least until we get a clarity on monsoons, will likely do much better. So something like a Hindustan Unilever could be something which we are keenly watching. The other two large sectors, oil and gas and maybe automobiles, it's a bit of a question because, refiners, they've already put in the windfall tax. They're now talking about, doing the similar thing on the upstream as well. So gas, which has typically been great so far, might not, be a great investment as we speak. And auto, frankly, the best performing sector over the last 1 year. But I think what has happened so far in terms of stock performance is that it has risen because of the rise in the embedded value. So a lot of PE investors, because they are sort of spraying and praying, are essentially investing everywhere. And until we as secondary market investors are able to understand who could be the winner of the lot, our gains might not be that high in this sector going forward. So I think the places we are actively watching clearly are banking and relative lending spaces, few domestic facing sectors like hotels, etc., and FMCG selectively on the urban plays.
Hi, Jigar. Morning. What has been that one standout performance for you so far, from your universe of stocks?
HCL Tech is something that we own even within this space. And I think if you look at the tech names, it's the first time that the growth has come into such a tight band, right? Everyone was between like 3 and 5.3% or 3.5 and 5.3% CC. Now, this is one place where, it has not, the stocks are reasonably down from their, 52-week highs. But this is one company which we are relatively better positioned in terms of where the street is. So that's one company which looks reasonably good. Otherwise, I think, whatever numbers, I'm just going through the list here. But yeah, Federal Bank was good. HDFC Bank was good. Cement has been bad as estimated. And again, this could be the worst quarter because your coal prices and everything else was much higher. So going forward, it could be interesting, but I think HCL Tech did stand out vis-a-vis the companies that we own among the results reported so far.
Okay, so HCL Tech is the standout performer of the earnings season so far, according to Jigar. Can you talk about the FMCG stocks which are unaffected by the rural weakness, which have a greater urban presence? Nestle is a stock which comes to my mind, which is a low rural presence. But could you tell us the other names?
Right. Also, Rima, what's happening is that raw material and fuel. I think not just of these places, but all consumption facing. If you take as a play, then you are seeing raw materials and fuel, both of those costs subsiding. So some auto names might also make the cut here if you're just talking of quarterly results. Also, Hindustan Unilever has 17 odd categories, and there are several. We don't really understand the breakdown of the EBITDA per se vis-a-vis what drives what, and therefore our estimate is that we'll likely see a large amount of margin expansion from few of those categories within Hindustan Unilever, and that's one business which is looking really interesting to us at this juncture.
All right. Jigar, we don't have the metal earnings in, but I want to ask you about this space anyway. We have been talking about the kind of cuts that have come through here. Do you think that there's more pain for this space, and how do you expect the earnings also to pan out here?
Hi, Pavitra. So yes, the sad part of metals is that, even when the physical demand is reasonably strong, which I suspect is the case with, say, aluminum or zinc, because these metals are listed on the indices, so London Metal Exchange or Shanghai Composite Exchange. In that scenario, you have liquidity impacting their pricing per se. So when central bank liquidity has gone down by, say, about $1.5 trillion from its peak, the withdrawal of liquidity has not just happened from emerging markets, but also from a lot of this commodity plays. And that is impacting the valuation. If you look at the regional premia, so typically a company, when they sell, they take the LME and then they take the regional premia, which is indicative of the physical tightness of that commodity, and that is still going strong. So sadly, most of these companies, when they report and when they sell at the price listed on LME, and therefore the numbers will not be great. Steel, which is not listed, and whatever does trade on LMEs does not attract a lot of volumes. That might be relatively better, but then India did impose an export duty, and that would be companies would be suffering on that account. So at one point in time, what looked like a great driver of earnings for Nifty, and it was the case, right? Top 4 companies in FY22, 3 of which were, or rather all 4 commodities, if you include ONGC, are actually going to lag the Nifty earnings. So in one stretch, the quality of Nifty earnings is improving, but metals will be the only index, I think, in FY sort of 23 and 24 to report a negative growth in earnings.